let me give you a backstory about myself and primary residential mortgage as a whole. So obviously, a mortgage company is going to be your best asset, your best partner in the transaction, because at the end of the day, I always tell people we have your commission check, and we need to make sure that what we say is actually going to get to closing. So it is important, obviously, for you guys to not necessarily just take the borrower's word on that they've been pre-approved, or confirm all that information is accurate. You want to be hesitant of Rocket Mortgage, not to talk badly about another company, or an online brokerage or mortgage company rather, because at the end of the day, just like real estate, mortgages are local, right? So you want to be able to make sure that your client is working with somebody that knows what's going on, accessible, and knows the products and programs. So this is a little booklet that I created a while ago. I've been in the business 16 years. Primary Residential Mortgage is a national company. We go short for PRMI because Primary Residential Mortgage is a mouthful. So PRMI is a national company. We're in every state but New York. We do about $13 billion a year in business. Our divisional office for Maryland, Pennsylvania, Delaware, DC is based on Joppa Road in Towson. And out of that little office, we do about $1.3 billion worth of business, predominantly in this marketplace. So we like to say we live here, we lend here. That's our little motto. And what I want to do is go through this whole little booklet that I go over with home buyers, because I think a educated realtor, to understand the finances just enough to talk about it, you're going to differentiate yourself from the other realtors that are out there, because it's amazing how many realtors don't actually know what they're doing when it comes to financing or finances. And all they do is just say, hey, go for the lowest rate. And that doesn't mean necessarily the best product. So as I mentioned, 16 years in this business. When I bought my first house, prior to getting into the business, I met with a mortgage guy. He said, sign there, date there, date there, sign there, date there, date there. I did exactly that. He told me payment was X. Payment ended up being Y, a lot more than X. I hated the entire process. So fast forward 6 months later, I'm in the mortgage business, and I created this little booklet, as we mentioned here, that will go over what goes into qualifying a borrower. And it gives the borrower just enough information for them to make an educated decision, and you just enough information as an agent to understand the process. So the meat of this booklet, and if you guys want to email me your email, I'll send you a copy of this and a little home buying video that I include on it, which is 2 minutes long. So my email, just if you want to write it down, obviously everybody's in front of their computer, is jwald, WALD.net. Or sorry, at primeres.com. So jwald at primeres.com, PRIMERES.com. So let's go over, when we're qualifying a borrower, I always tell people there's 3 pieces to the pie. The first piece of the pie is your credit and your credit score. When we're reviewing a borrower's profile, we're looking at their credit history and their credit score. In a perfect world, you're going to have a 760 credit score or higher. Okay. And in addition to your credit score, oh, you guys see, I don't see the booklet. Do you see the screen right now?
It's just like a blank screen with white.
Oh, really?
Right. Yeah, you're not sharing your screen.
Yeah.
There it is.
There it is.
You see it now?
Yes.
Okay. Sorry. So we missed that whole beginning here. But here's the booklet that we went over, right? And then, oh, here we go. So this is the page that I always talk about. That's, kind of these 3 pages of the meat of this booklet. Everything else is kind of fluff, right? Not necessarily fluff. There's important stuff in it, but this is where I spend most of my time when I meet with a borrower and have a discussion with a borrower, either on person, Zoom, or over the phone. So as I mentioned, the first thing that we're looking at is your credit. In a perfect world, a borrower is going to have a 760 credit score or higher. We use the middle of the 3 credit bureaus. So we have Equifax, Experian, and TransUnion. So we use the middle of the 3 credit bureaus as the credit determining factor for your credit score. in addition to your credit, in regards to your credit score, we also look at what's on your credit report. So in order to maintain that credit score of X, we have to make sure that you have trade lines that are reporting. So your credit cards, your student loans, your car payment, anything that's reflected on your credit report, we're going to look at too. And we only care about the minimum monthly payments on that. So if you have a credit card that you pay off every single month, or you pay a $500 balance every single month, but you have to pay $75 a month to keep that line open, we only care about the $75 a month minimum payment that you have to pay. Does that make sense?
Yeah, it makes sense.
So the second thing that we look at when we qualify a borrower for a loan is what's called loan to value ratio. Loan to value ratio is determined by taking your loan amount and dividing it by your purchase price. The acronym that we use all the time is what's called LTV, right? Because we're not very original. So loan to value ratio, again, is if you're borrowing or you're buying a $100,000 home and you're borrowing $80,000 from us, then your loan to value ratio would be 80 divided by 100, which at that point would be 80%, which means that you would be putting down 20%. So what impacts the loan to value ratio is your down payment. And a myth for a lot of home buyers is that you have to put down 20% in order to buy a home. That's completely not true. There's some products that are 100% financing. There's grant programs that we could give towards down payment closing costs. And then you could do a conventional conforming loan with as little as 3%, which we'll talk about in a second. So loan to value ratio is the second part that is impacted when you're qualifying a borrower for a loan. So again, credit, loan to value ratio, they have control on these two items. What we have control on, meaning as a lender to determine whether or not you're quote unquote pre-approved, is we have to make sure the debt to total income ratio matches up, and that's known as DTI. So we take the total monthly debts, your credit cards, your student loans, your car payment, we add it to your new mortgage payment, and we divide it by your gross monthly income. Gross monthly income is important. So if you make $60,000 a year, that's $5,000 a month, right? But you're not taking home $5,000 a month. You're likely taking home $3,200 a month. But we're qualifying you on the $5,000, your gross monthly income. And we don't want to see your debt to total income ratio in a perfect world, again, exceed 45%. That's the cap. That's the highest that we really want to see the debt to total income ratio to stay at or below. So, again, simple math. If a borrower, let's say borrowers, right, make $10,000 a month, $120,000 a year, they want to buy a house, their total debt capacity, including their new mortgage, credit card, student loans, and car payment, cannot exceed $4,500 a month. Does that math all kind of make sense too?
Yep, it does.
All right. So when we qualify a borrower, right, in addition to qualifying a borrower on these terms, right, credit, loan to value ratio, and debt to total income ratio, we're also trying to figure out what's going to be the best product for a home buyer. There are four products when you're qualifying a borrower. There's FHA, conventional, VA, and USDA. The two most common types of mortgages are FHA and conventional. In order to get a VA loan, you have to be a veteran. And in order to do a VA loan, again, you have to be a veteran, served in the US military, have honorable discharge, et cetera, et cetera. A VA loan is the absolute best possible loan out there. It's 100% financing, no monthly mortgage insurance premium, and there's no limit on seller contribution. So the seller could pay all the closing costs if you negotiate that into the contract. A USDA loan is a rural housing loan, right? I wouldn't say it's not common, but it's, I'll say it's not common. It's not very common, especially, for our marketplace here, but a USDA loan is 100% financing also, but you have to buy in what's deemed as a rural area. And the USDA financing is very specific on not only your area, but also your income and your household income. So the God's honest truth is you're probably not going to be dealing with very many USDA loans. If you get a veteran, then you hit the gold mine. It's the easiest loan. It's an easy product. And just an awesome loan. I'm always happy to help you understand that in greater detail. But I want to focus on FHA and conventional because, again, like I said, this is what's out there for the general public. An FHA loan says that the borrower must put down a minimum of 3.5%, which means that we could finance 96.5% of the house. In here, it says minimum credit score is 620. That's not true because that's been adjusted. This booklet's a little old. There's not necessarily a minimum credit score, but you want to have a borrower at least a 580 credit score to do this. You do have the ability to ask for up to 6% of the sales price towards closing cost. It's rare in this market to get that, but you do have the ability to ask the seller, if you're buying a $100,000 house, to contribute $6,000 towards your closing cost. It's a government insured loan. And why I put that it's a government insured loan here is because there's going to be something called mortgage insurance and upfront mortgage insurance. And the monthly or mortgage insurance is going to be set across the board. It doesn't matter if you're buying, it doesn't matter if you have 800 credit score or 580 credit score. The mortgage insurance is going to be the exact same across the board, no matter if you have excellent credit or mediocre credit. And that mortgage insurance premium is 0.85% of the loan amount that you have to pay every single month. Okay. Any questions on FHA at all? I guess not. You're breaking up a little bit.
I was just saying,
Okay, I don't know. All right, so the next thing is the conventional conforming product, right? Conventional conforming requires that you put down 3% minimum. Now that's going to be for a first-time home buyer. If you are not a first-time home buyer, then you're going to have to put down 5%. When you put down anything less than 10% on a conventional conforming loan, the max that the seller can contribute towards closing costs is going to be 3% of the sales price. Okay. When you put down 10% or greater, you do have, on a primary residence, you do have the ability to ask the seller to contribute up to 6% of the sales price towards closing cost. The big difference between FHA and conventional is the monthly mortgage insurance premium. So the monthly mortgage insurance premium on a conventional conforming loan is going to be significantly lower if you have higher credit score. And then the other thing is, with an FHA loan, you have to pay what's called upfront mortgage insurance premium, whereas a conventional conforming loan, you don't need to pay the upfront mortgage insurance premium. Long story short is, if you have a higher credit score and some money to put down, conventional conforming is going to be a better product for you for the long term. That's not to say that FHA is a bad loan. It's an awesome loan. I personally have had 2 FHA loans in my time. It's a good starter loan, but it's not necessarily a loan that you want to be in for the rest of your life. And this, what we're talking about here, is just primary residence. If you guys have an investor, the investor, and they're going to buy an investment property, they have to put down at least 15%. Anything there? Okay. So let's talk about when you're buying a home. When you're buying a home, you have to pay closing costs, right? And this is the part where most home buyers are just completely in shock with the charge, right? So our company charges $16.95. That's our transactional cost. The appraisal fee has actually gone up over the years. It's around $550 now. And that's the cost to appraise the property and make sure the buyer's buying it for the right price. The realtor admin fee is on average actually around $495 these days, not necessarily $375. A title company is there to verify that you're buying the house from the rightful owner. They typically charge an attorney fee of around $1,100. And then you have to get title insurance, which will cover you and us as the lender to make sure that they're buying the house from the rightful owner, right? Kind of important. And also protects them from any past liens that come up. when they get owner's title insurance. And then, like going to the store and buying a stick of gum, you have to pay the state and the city charges. The transfer tax, this is for Baltimore City, which happens to be the highest of all counties to buy a home in. The transfer tax in Baltimore City is 1.5% of the sales price. The recordation tax is 1%, and the state tax is 0.5%. So like you're paying 3% of the sales price when you're buying a home. So if you're buying a $200,000 house, you're paying $6,000 to buy that $200,000 house in Baltimore City. You'll likely see in the standard, GBBR contract, MAR contract, it's split between buyer and seller equally. So instead of paying $6,000 in that particular case, or 3% in that particular case, you're paying 1.5, or your buyer's paying 1.5, and the seller's picking up the other 1.5. The advantage for a first-time home buyer is that your portion of the state transfer tax will be waived on your first purchase in Maryland. So it doesn't mean if you were a first-time home buyer, if you owned a house in Texas, right, and you're buying a house in Maryland, for the first time, you're considered a first-time home buyer in Maryland, so your portion of the state tax is waived. And then the last part about buying a home is what's called your escrows. So when you're buying a home and a buyer's like, hey, I want my payment, my principal, interest, taxes, and insurance payment to be at or below a certain number, they're talking about what's included in that is their escrow account. And we have to pre-fund that escrow account. So we're collecting anywhere from 9 to 10 months worth of taxes at the time of settlement. Plus we're collecting 1 year of homeowners insurance, plus an additional 2 to 3 months on top of that. Long story short, this is a good number for you guys to write down. If you're buying a home in Baltimore City and it's $250,000 or more, prepare your buyer that the closing cost, which are, again, all these fees that are listed on this page, come to 4.5% of the sales price in Baltimore City. So in a $250,000 house or greater, it's going to be around 4.5%. On a $250,000 house in Baltimore County or the surrounding counties, it's going to be around 4%. On a lower priced home, that percentage is going to be higher, because it doesn't matter if you're buying $1 million house or a $100,000 house. There are set fees in that transaction which bring that percentage higher, which is why I can't rattle off, a percentage, say, for a 185 house. The other thing to consider is property taxes. The actual property taxes of the home impact your closing cost, because if the property taxes are $500 a month and we have to collect for 10 months worth of property taxes, that's $5,000. But if the property taxes are $300 a month and we got to collect for 10 months worth of property taxes, that's $3,000. That's a difference of $2,000 in your closing cost. So property taxes have a big impact on your monthly payment, and it has a big impact on your closing costs too. Any questions in regards to this?
Can we have a copy of this booklet?
Yeah.
We just see the first page, like we don't see, I don't know if
Yep.
you're scrolling through it or not, but.
Oh, you don't, do you see what I'm doing here, the closing cost page?
No, we just see the home buying process, what you need to know, like the first part.
Oh, you
I guess
kidding
the
me?
top first page.
So you haven't seen this? Do you see this in here?
Now we can see it. Before, I think
kidding
it just
That's
kind of
okay.
got
I'm
stuck.
following what you're saying. It was just a lot of info, so I wanted to make sure.
Oh, yeah,
There,
okay.
now I can see it.
Yeah. All right. I apologize about that, because from what I'm looking at a screen here and it's showing that I'm sharing that screen. But you guys see this portion where it says credit loan to value ratio?
I can see the pages now. I don't know. I won't remember them.
Yeah. I'll send you, like I said, I have this little home buying video that I always include in my emails, which I'll send to you, which kind of goes over this.
Okay.
But yeah, I truly apologize. I was sitting here.
No, no
going through all
problem.
this.
I followed it all along well until it was a
Yeah.
big drop of information. And I was like, wait a
Yeah.
minute.
Yeah.
Thank you.
So, I mean, this booklet again has like what you need as a buyer, 1 month of pay stubs, tax returns, all that stuff, the process flow, a copy of what's called a loan estimate. The loan estimate is going to be provided to the buyer once they make an application with the lender. So this just gives them, the ability to review this and know what's potentially on the loan estimate for the future. And then throughout this, you'll also see like a closing disclosure, which will be provided to the buyer within 3 days of settlement. And the closing disclosure is going to outline the monthly payment, and it's going to outline the cash that the buyer needs to wire to the title company for closing. So it's got just some different things in here. I have a printed copy, which I always give out to buyers when we were meeting people face to face, and it goes in little house hunting tips, et cetera, et cetera. But what are some like obstacles that you guys are experiencing? What are some uncertainties that you have in regards to the lending world?
The thing for me, just what products are mostly available these days, action. So, and last year it was sellers, so I haven't really been involved with buyers for a while. I mean, myself personally, I'll be looking, my husband and I are looking, and we were thinking of building a house, and then now we're not sure whether we want to build or we want to buy, but we're just kind of seeing the different options, what's out there as far as loans, like for us. For example, one bank that's local was saying we could refi the house we're in, and then I hadn't heard this before, but they said we could, it would be a lower rate than we're already paying, and they said we could do interest only for 10 years, which I hadn't heard of that before, and then use equity towards the purchase of, our other home or whatever, if we end up building, towards the land. And then like, that was something new I hadn't heard before. So for me, it's just getting up to speed and understanding what different products are out there, I guess.
Yeah. I mean, well, for most consumers, it's going to be the standard 30-year fix, but you do still have the interest only options. It's not as prevalent. Interest only is not really always the best option for most people, especially people that are going to be in the property for a long term. But, if it's a short term, that's not a bad option, especially with the market appreciating at the rate that it's appreciating. And you're not going to be paying down the principal very much in the first 5 years anyway.
Right.
There are,
like a short-term thing.
Yeah, exactly. So that's a good idea for a short-term thing. The other thing that's a popular product, there's a few popular products. Depends on what your market is. Like I do a lot of renovation loans, which allows you to buy the property in any dilapidated shape it's in. And you could roll in all the renovation costs into the transaction.
Okay.
So like years ago, my wife and I use this example because it springboarded us to buy the house that we're in now. But we bought a house in Canton for $100,000 years ago. Obviously you can't find that anymore. We put 120 into it. We lived in it for 5 years and sold it for $300,000. And then we used that money to buy the next house that we live in. So it's, renovation loans a great way to build equity for people. And then there's also depending on your market, there's another product out there that's called Smart Buy 3.0.
There's some background noise right here.
Let me see. There you go. There's a product called Smart Buy 3.0, which allows a buyer to pay off up to $30,000 of student loan debt into the transaction, which is really good for, those guys and girls that just got out of college, and have $30,000 in student loans and also want to buy a house. The downside with it is the interest rate's slightly higher than what the market rate is. But if you do the math, you wipe out $30,000 worth of student loans in 5 years, because you have to be in the house for 5 years for it to be completely wiped out. Your payment's going to still be so much less than if you had to pay the student loans and buy a house. So there's a ton of different products. You know, as I think the big questions, like for a agent, especially a newer agent, where you know, there's some lenders that have been in the business for a while and they don't even understand the product. So I wouldn't overwhelm yourself on understanding it, but I would understand, like, or engulfing yourself in understanding it. I would understand the basics. Like, the question that a lot of people should ask as an agent is, do you have student loan debt? And if they say yes, well, cool. Let me hook you up with a lender that has a product that will pay off student loan debt when you buy a house. Now there's a lot of, if it's like fitting a square peg in a round hole, unfortunately, sometimes, because it cannot be more than $30,000 in student loan debt. If, say, they have $40,000 in student loan debt, then they have to come to the table with that extra $10,000, because at the time of settlement, all the student loan debt has to be wiped out.
Oh, got it. Okay.
You know, but there are a lot of people that have 25, 30 grand of student loan debt and want to buy a house. And we've helped a lot of people do that.
That's
So,
great. Yeah, I've never heard of that. That's a great thing to know.
Yep.
Hello?
Yep.
Can you hear me?
Yep. I got you.
Yes. With that type of loan also, where does it go? Does it go onto the loan, or does it end up being paid off? Or does it just go into like the back of, onto the actual loan?
Yeah, so it's called the Maryland, if you guys want to Google it, right? It's called the Maryland Mortgage Smart Buy 3.0. And I'll send you if you guys, I don't have everybody's email here, but if I'll give you my email one more time. If you send me an email, I'll send you a follow-up with some of this stuff. But the Smart Buy, what it is it's a forgivable. So they'll put $30,000. Let's say you have $30,000 of student loan debt that you're going to pay off.
Right.
They put the $30,000 as a forgivable second mortgage.
I see.
And after 5 years, it's fully forgiven. It's forgiven at a 20% rate every year until the 5th year, when you have to pay nothing back.
Okay, but are they making payments towards it in that 5-year period?
No, not at all.
Oh, okay. So it's just kind of hanging out, and portions of it are I guess forgiven as you make your way through the 5 years.
Exactly. So if you sell your house, say on year 4, right?
Right.
And you haven't been in it for 5 years, you're going to have, say, $8,000 in student loan debt, or not student loan debt. You're going to have an $8,000 loan that you have to pay off with the sale of your house.
I see.
So it's an incredible product. And also talk about marketing, like, because look, at the end of the day, like, we're self-employed, right? And in a sense, right? We have to be our salesperson. We have to run a P&L. We have to educate ourselves, and we also have to market. So this product is an incredible product. These two products, the Renovation Loan and the Smart Buy. But the Smart Buy product's awesome because, I hate to say it, Facebook's become a marketing tool, not necessarily what it was built out to be. But we show up with a publisher size clearinghouse check, right? That says $30,000. We write the borrower's name on it. We say Smart Buy 2.0, and we take a picture and we market it on Facebook. I almost guarantee you will get 5 phone calls in the first week that's up from friends or family that see that. So it's a great marketing tool. And then the Renovation Loan, you can't find a better product for somebody to build instant equity. In this market, it's hard to find instant equity because, everything's not necessarily inflated, but the market's busy. We're very low on our supply. So the renovation loan is awesome because they could find grandma's dilapidated house with pink bathroom, ugly kitchen, and we could roll in all the renovation, to make that house look like a modern house. And at that point, they have the equity in that house, and they hopefully would have gotten a deal on the front end because nobody wanted grandma's house.
Right. Now, a question again that I have, do you have anything like that for investors? The investors portion is so high to put down usually.
Yeah.
What do you have where they don't have to put down so much? Because I get people that are kind of, I guess, new to it, that may have a home already and they want to invest, but the down payment is kind of high.
So we don't have a investor renovation product per se. And
Okay.
the reason is because it's extremely risky. And what homeowners and real estate agents don't realize is Dodd-Frank, which was the Financial Reform Act that turned our industry upside down, which actually made it better in some parts, but made it worse in other parts. If a buyer does not make a payment in the first 6 months of taking out a loan, or sells their property within the first 6 months of making a loan, us as the loan officer is penalized, and I have to refund my commission, which is really kind of messed up, right? Imagine like you sold somebody a home, did all the work, and then they sold that house, and then you have to refund your commission. So it's a very risky product, but I do work with banks that will help investors, or a local bank that will help investors, but they do require 20% down minimum.
Okay. But how do they help the investor?
Well, because they could do like an investor renovation loan, which
I see.
will give them cash to renovate the property.
Okay.
But yeah, it's there's not necessarily going to be the investor market. The best thing for an investor is the 15% down option.
Right. And that one was, you mentioned that earlier, was kind of like what was the name of it?
The 15% down option is just a standard conventional conforming loan. So it's just an investor product of it. You could do 15% down. Now, when you do an investor loan, the most seller contribution that you could ask for is 2% of the sales price. So on a conventional product, if it was going to be your primary residence, you were to put down 10% or 15%, you could ask the seller to pay 6% of the sales price towards closing costs.
Right, but if this is a true investor that doesn't, it's not going to be their primary residence, they're planning on selling it, then what would they do?
Then they would have to, if they're planning on selling it, then they would have to work with like a hard money lender or a local bank that would be willing to take that risk.
Okay.
Yeah, because if you're going to flip it, then
right,
you cannot get a loan. You can't get a conventional loan. Like
right.
you can't get a loan through a lender such as ourselves. You would have to work with a hard money lender.
Okay.
Which obviously eat into their profit.
What's the timeline on flipping it? I mean, isn't there a timeline? Is it 2 years or something if they want conventional, or if they get a conventional for an investor?
Well, there's no necessarily. So if you were to get a property and then flip it in 2 year period, is that what you're asking? Like, or
is there like a time frame versus where you need a hard money lender versus be able to get a conventional loan as an investor?
Yeah, I mean, as an investor, your intention at the time of taking out the mortgage is to hold the mortgage for, there's not a set date, but I would say for the lender's purpose, the loan officer's perspective, I mean, at least 8 months to a year should be their intention. Now to your question about 2 years, you are right about the 2 years. If you hold on to a property and you sell it in, I think, under 2 years, I'm not a tax advisor, but you will be subject to capital gains.
Okay. Yeah.
So
I knew there was something with 2 years.
Yeah. It's a capital gains tax that if you sell a property in shorter than a 2-year period, that you're going to be subject to capital gains.
That makes sense.
So, but the other thing too is the best. So as an agent, right? Like, again, your job is not to engulf yourself so much into our world, though you absolutely need to understand it. There's 2 things that I would advise. The first thing is, if you do have a client that is truly interested in getting qualified, set up a time with the lender, hopefully me, right? Set up a time with the lender, set up a time with the buyer, and ask the buyer if they're comfortable with you sitting in the consultation. Because I think the first 3 to 5 times that you sit in on a consultation with a lender and buyer, it's going to give you a better perspective of what the buyers are going through, and you're going to have a full understanding of kind of the process on our end. Now, most first-time home buyers don't know that that's not typical, right? So if you do that, there's a very good chance that, you say, hey, look, I usually sit in on the first meeting with the lender. If you're comfortable with it, sometimes we're going to go over your income and your assets. If you're uncomfortable with it, then just let me know, and I'm happy not to sit in. But it's better if we're all on the same page and we know what's going on. And if you do that for the first few times, you're going to get a really, really good grasp of what we do. And I did that with an agent that I work with now. He was a chef, actually, before getting into this business, and wanted to understand our world. So the first few deals he did were for friends, and he sat in on the meetings in person. And now the guy's doing $22 million a year in real estate, and he could spit off the terminology enough to make the buyer think, like, this guy really knows his stuff when it comes to lending. So I think that's a tip that I would give to newer agents. And I definitely think that that's something you should get going on. The other thing is, introduce your client to the lender through email. Don't give your buyer, don't say, hey, buyer, Mr. Buyer, here's my lender's card, call him. They're not going to call me. You need to be the one to initiate it and say, hey, Jennifer, I know you're going to be buying a home in the next 6 months. I want you to talk to a local lender that I trust. I'm going to pair you up with a lender in the next day or so. And I would encourage you to set aside 45 minutes to have a consultation with that lender so that we know what we could go out looking for. And at that moment, once you get their buy-in, type up an email and just say, hey, Mrs. Smith, it was a pleasure talking with you. As I mentioned, the local lender I want to refer you to is Jon Wald. I'm going to put you on he's CC'd on this email. Please set up a time to meet with him in the near future. I'll reply with my standard email, trying to set up a Zoom call, in-person meeting, or a phone call with them. And again, like I said, if you give the buyer the choice to do it, this is where Rocket Mortgage and online banks are excelling, because they understand people are afraid to have human contact, and they're also sometimes lazy, right? It's easier to click button, get mortgage, but clicking button, getting mortgage doesn't mean that we're setting them up in the right mortgage. So it's really important. I always tell people, your realtor is going to be your best friend, which you guys will be for the next 6 months with that client, but they're going to be paying me for 30 years. So they might as well set aside 45 minutes to have a consultation with me.
Thank you. That's really helpful.
Yeah, of course. And I mean, it is an important process that we're teammates, and that's the way that I look at our business, and my team looks at everything. Is, it's not like the realtor and the lender and we're two separate entities. We are a team. And I tell buyers, again, though I'm not going to be out looking at a house with you on Saturday and Sunday, that's what your agent's going to do. However, I am going to be available on Saturday and Sunday if you want me to run numbers on a particular property. And it's important, before they submit an offer, to consult the lender and have the lender put together an estimate for that buyer so they know what they're getting themselves into, because every property's taxes are different. So just because we anticipated the property taxes to be $400 a month, it very well may not be $400 a month. It could be $800 a month. And at that point, the buyer doesn't want to buy the house. So I always say, keep me involved in the whole process and let me know what's going on. And I have to tell some buyers, like, don't send me every house that you're looking at with the agent on Saturday and Sunday, but pick out one or two that you think could be the one, and my team will put together an estimate for you. So, but yeah, I mean, that's the gist. I mean, is there any other questions that you guys want to touch on, that you've got, concerns about when it comes to lending?
No, I think I'm good for now. Thanks.
All right, cool.
Yes, I am as well. Thank you.
Awesome. And let me give you guys my email address one more time.
Okay.
Is your email attached to the Zoom call? I think it is.
Is it?
Because I
Okay,
can
good.
just email you from that, because I don't have a pen or anything. I'm
Yep.
kind of in a hall.
That's fine. Yeah, I think it is. If not,
I think it is.
Yeah, and I could grab your information too, but it's just John or J Wald, so the letter J and then WALD at prime PRIME res.com. So, and I'll shoot you guys some information. I'll send you information on the Smart Buy 3.0, because that's a good thing to kind of market with. Again, the real estate's marketing, right? So like, a good idea is I'll send you this stuff on the Smart Buy 3.0. You could take the flyer that I'm going to send to you, and you could even post it on Facebook and just say, hey, I had a great meeting with the local lender. We talked about this awesome product. Did you know that you could pay off $30,000 worth of student loan debt when you buy a house? You'll get a call or two from that. Now, they may not qualify particularly for that product, but it will get them talking in the whole process of things.
So with that product, just to make sure I understand, the bank, so you were saying it's a second mortgage, right? That's forgivable, but how does the bank, does the bank pay the student loan off?
Yep.
You're saying,
Yeah.
so then it just gets recorded and it's forgivable 20% a year for 5 years.
Exactly. Yep.
Okay.
If you have $30,000 in student loan debt with Nelnet or whatever, right?
Yeah.
Then at the time of settlement, the title company will write a check to that student loan company and pay the entire balance off. And then there's going to be a $30,000 second mortgage tied to the property that's recorded.
Gotcha.
And you could buy a house in any part of Maryland.
Okay.
With this.
And how much higher is the loan rate for that product? Do you have any idea?
It's usually about, I would say, 0.75 to 0.75% higher.
Okay.
It's not atrocious. So
Do they have to be first-time home buyers, or?
you do have to be a first-time home
Okay.
buyer. Yeah.
All right.
Okay.
Yeah.
And in the state of Maryland, it's a Maryland program, right?
Only Maryland. Yep.
Okay.
Yeah.
All right. Great. Thank you.
And then there's another product through the state of Maryland too that is allows them to get a grant, a fully forgiven grant of 4% of the sales price, which could be used for down payment. So, and I don't like to go overwhelm people with all the different grants and the state programs and products, but there are some really good programs and products for home buyers out there, that is administered through the state of Maryland.
Okay.
And I don't know if you could see my screen. I hope you can.
Yeah, I can see that.
Okay, so this is the interest rate for the Smart Buy, Maryland Smart Buy 3.0. It's 4%. So it's, again, it's a little bit higher, but it's kind of comical when I'm like quoting buyers like 2.99% is their interest rate and they're balking at it. I'm like, I've been doing this for 16 years. One of the first deals I did was 7.5% interest rate with 2 points, so,
Yeah, it's the times that we're in.
I know, right?
insane.
That's one good thing, I guess.
It's insane.
Yeah.
So, but yeah, so 4% would be the rate on the Smart Buy 3.0, which is really on it. It's really not a bad rate. considering you're wiping out 30 grand worth of student loan debt. And then
Yeah,
if rates are still low in 5 years from now and you're still in that house, then you go ahead and refi to a lower interest rate.
makes sense.
So,
All right, thank
but
you.
yeah,
Thanks so much for your time. This was really
Yeah.
informative.
Yeah, it was
well, I
helpful.
appreciate you
Thank you.
guys. Yeah, no problem. So I anticipated a class full. I didn't realize I was teaching it on Zoom, to be full disclosure. So I printed out all this paperwork. I got it here at the office. But like I said, I'll send you the booklet that I have. I'll send you the little video. And I'm updating a few things. So once I also get that updated, I'll send that to you. But I'll send you breakdowns of all this so you're aware of everything. And if you got questions, and especially if you got clients, I'd appreciate it if you refer it to me.
Okay,
And we'll get you rocking and rolling.
great.
All right,
Will
thank
do.
you. I did send you my email because
Okay,
I don't
perfect.
see yours in that original Zoom. So if you can get it from the chat, thank you.
Yeah, no problem. So I'll pull it up and I'll make sure I got everybody's email, and we'll get you guys rocking and rolling. And again, thank you guys for your time, and I appreciate it.
All right, thank you.
Okay, thank
Yep.
you. Have a great
Take
day.
care.
You too. Take it easy.
Have a good day. You too.